Hi, I'm Dan Fiori. I am a finance major and an undergrad at PC. I believe that I can be a valuable asset to the Research Challenge team because over the summer I interned at Morgan Stanley and I primarily focused in research. I am very analytical and I learn quickly and I adapt quickly to changes in whatever comes about, and I always try to find the right answer, so I believe I can use all of these skills to be a valuable asset to the CFA Research Challenge team.
Hi, good afternoon. My name is Sarah Clausius-Parks. I'm an MBA student here at Providence College. I am currently trying to be part of the team because I have over 10 years of experience in the field, and I also have the leadership skills to help organize the team and lead them to victory.
Hi, my name is Chris Little. I'm currently an MBA student with a concentration in finance. I've had experience in the last year as an MBA student doing financial analysis, and I think that would be a great asset to the team. And also, I'm interested in pursuing my CFA in the future after I finish my MBA this coming spring. So that's why I'm here today as well.
Great. Our presentation today is on Coach. We've titled our presentation, Tightening the Purse Strings. First, I'm going to discuss the business description and competitive positioning. After decreasing revenues, earnings, and stock price, Coach decided to bring on a new CEO, Victor Luis, in January 2014, and a new COO, Gerber Rayner, in September 2014. They're hoping to kind of change the trend of decreasing revenues with these new leaders. They also purchased Stuart Weitzman, a designer footwear company, in 2015. They found this company had similar business and product strategies to Coach and thought that they could lead to increased revenues. Coach is trying to reposition itself in the market. They're calling this their transformation initiative. They're going to go for higher priced items and make themselves a more luxury brand. And they've actually had good results in their Asian markets. About 1/3 of their sales come from Asia, and there's been some steady growth, but there is concern with the current environment there that sales may start to decrease.
I'd just like to highlight a few things through a financial analysis. Here's some financial data that's I think relevant and important in determining what we're going to do as far as holding, buying, or selling the stock. The first thing I'd like to highlight is, as you can see with this chart here, is that there has been a drastic negative change in EPS value in the recent past, and that it's a change in the negative they have not seen for over 5 years, and that this is very important as far as investors go. Investors value EPS as earnings per share, which is basically saying to investors, this is how much you earn for investing in our company, this is how much your investment is worth. And so you see with the decrease in the earnings per share in the recent past, the trend is, the investors have to ask the question, is this going to be the earnings that I've received in the past for this stock, am I going to continue getting those earnings? And what is the company doing to protect my value in the company, my investment in the company, so continue to get those earnings and the income that I expect from my investment. Also, another item I'd like to highlight is the profitability margins. As you can see, from December 2013 to 2014, there was a small decrease in the margins of gross margin, net margin, in the return on assets and equity especially. And then you see almost a 50% decrease from 2014 to 2015 in return on equity and assets as well as net margin. I think this is very important because this indicates to investors about what they're getting in return for their investment into the company and what also management is doing with the assets that are already in the company and the investment from stockholders. And so this decrease, investors are asking the question whether this is going to be a longer term trend in the next few years, whether they're going to continue to see a decrease in a return for them, or if the company is going to be able to turn around this trend in the last few years through the purchase and acquisition of Stuart Weitzman, as well as taking on the extra debt in the fiscal year 2014-2015 for the purchase of or acquisition of that company, whether they can turn that around. Also, if you want to go to the next slide. Also, something else I would like to highlight in contrast to what we've seen, even though the margins are going down and you see a less investment, the company is continuing to keep up its operating efficiencies. It's actually decreased its receivables turnover, so they're able to turn those credit sales into cash more quick, or accounts receivables much faster. And so that's very important that as the company goes through this transition of adding and integrating the acquisition into Coach, that they're able to continue to operate efficiently so that they can eventually turn around their earnings per share.
I'm going to be talking about the valuation on Coach. So first off, the price of Coach as of Friday is $29.44. So to start off with that, we can see where their upside and downside potential is and where the intrinsic values lie. So we started off with the PE ratio, and we found that when we valued Coach on their PE ratio, they have an upside potential of around 39%, whereas they have a downside potential of 27%. So they have a very wide upside and downside potential. So it's tricky to see on just one valuation. So we next gave a valuation on Coach relative to the S&P 500, and this gave a more narrow valuation. They had an upside potential of 20%, and they had a downside potential of 14%. But as you see with both of these two valuations, they have a little more upside potential than downside potential, which gives them a little higher of a reward, and that seems better to us, so we really like that. Next off, we gave a dividend yield valuation, and we found that through their dividend yield, they had a very large dividend yield difference between the last 3 years, which is 3 years is what I also did for PE and the relative PE. So if we look back 3 years, their high dividend yield and low dividend yield, we have an upside potential of 123%, whereas we only have a downside of 2.75%. So although this is a great valuation to use, we didn't give as much credit to this because it's so skewed. The last two were more based on intrinsic values of the firm compared to the price. Using the EV over EBITDA valuation, we found that the firm is valued at about $27, which is about an 8% downside, saying that Coach is overvalued. Whereas when we use the method of comparables, we compare them to 10 competing firms in the industry who had a PE ratio of about 18.4. So when we multiply that by the forecasted earnings per share, which based on Chris's trend, we forecasted their earnings to be a little less than what they were this year, and we forecasted their earnings per share to go down, we found that the intrinsic value of Coach is 34.04, which gives Coach an undervalued valuation.
We identified 3 investment risks for Coach right now. The first is they have to successfully execute the transformation initiative that they've rolled out. Without successful initiation of this, they're not going to be successful and the growth is going to decrease. Also, their international growth strategy must be executed successfully in order to increase revenues. And lastly, it's all dependent on the innovation of their competitors. If their competitors come out with other products and services that surprise Coach, this may cause a decrease in revenues for them. In conclusion, our recommendation is to hold. There's just too many variables right now for us to say that we'd purchase or we'd buy, so the recommendation is to hold. Thank you.
Thank you.